I think 36 central banks came out and said, yeah, we're buying gold directly from artisanals, we're not going through London anymore. If the price isn't really being settled in the AM and the PM fixes in London, or the silver fix at noon, if it's not being settled there, then where is it being settled? And the thing is, what's the real price? And I think people are saying, well, I don't trust any of that stuff. So basically, I'm just doing deals direct. I'll take ownership stakes. I'll just literally make agreements. And I think the LBMA, CME are losing control to be able to actually set a price, an FX price for gold. And so on.
Something big is happening beneath the surface of the gold market, and if you're not watching closely, you'll miss what matters. Russia is building its gold trading platform, set to go live by the end of 2025 on the St. Petersburg Exchange. This isn't a minor adjustment. It's a direct challenge to the London price fix that has shaped global gold pricing for decades. It's a break from the Western financial framework, not just in form, but in intent. AndrewMaguire, who spent years inside the gold trade, sees it. The real market is shifting toward physical, not paper. COMEX and LBMA, with their layered leverage and synthetic flows, are losing relevance. As China and Russia begin settling physical gold trades directly, those prices start to carry real weight. They reflect demand for metal, not speculation on derivatives. Consider the numbers. Russia produces approximately 300 tons of gold annually, ranking second only to China in gold production. However, it exports a sliver of that, roughly 2.37% of the global supply. The rest stays in country, deliberately hoarded. That's not inefficiency, it's policy. These reserves serve as a buffer, reducing dependence on the dollar and stabilizing future financial operations. What's more telling is how central banks are adjusting. The World Gold Council's latest data shows that institutions are moving away from Western exchanges altogether. They're buying gold directly from miners. Out of 36 central banks surveyed, 19 are already sourcing from domestic or small-scale producers, with another 4 preparing to join them. The shift is already underway. Maguire says it plainly. The old pricing mechanism is fading. The BRICS nations are building a parallel system, one grounded in tangible assets, not derivatives. The Western model, shaped by margin, leverage, and speculation, is increasingly out of step with how the rest of the world wants to trade. And this isn't some future scenario. It's already happening. Every off-market deal, every bilateral agreement, every ounce that changes hands without touching COMEX or the LBMA, it all chips away at the dominance of the old guard. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
What the amazing thing that I find I'm gobsmacked, to be honest, is that how the mainstream media and I mean very few people have picked up on the fact some good stuff, some major stuff went down at that BRICS Rio summit, and it was really, I mean, if one was going to sort of summarize it. And obviously it's difficult to do that, but it is the tokenization and the financialization of real world assets. And between the BRICS nations, they have literally, if you add in the energy complex, grain complex, all the different commodity complexes that they touch themselves, trillions of real world assets are potentially going to be digitized and really put into with the gold backing. Basically, the way I look at it, you were looking at a 7-step settlement process outside of the SWIFT. I think it's so major, and I just cannot believe that nobody is focused on it. All they've focused on, Paul, is Trump's threats to tariff the hell out of these guys. When how the hell you can tariff? I mean, this multipolar majority control the bulk of all commodity assets that they either consume or produce amongst themselves. So why the hell should you use a dollar trade when you're actually when you've got these different nations trading amongst each other? It's amazing to me. And I think as liquidity, and obviously as physical market liquidity flows into the West End, we have some really good connections. Our liquidity providers are very face China, face Russia, and obviously some of that stuff is not official because obviously there's sanctions against Russia. But I'm not saying our liquidity providers, but we are in contact with liquidity providers who are reliable. And I think what it is that we're seeing as this liquidity pours into China, and as you say, they're opening up vaults all around the world. Well, it's due to the very fungible nature of gold. So if you have gold vaulted in global vaults all over the world, and you have a transaction, it can be T+0 settled by simply moving it across from one vault or to the other side of the vault into that other nation's area. And of course, then it's globally fungible. So it doesn't have to move at some point. It doesn't actually have to move at all. So, because then say if it's in Singapore and it's against Brazil, then, why would you need to start shipping stuff around when it's a high quality, first tier, high quality liquid asset? It's a first tier asset. So it's cash. It's money. So to me, this is a game changer when we see that kind of stuff going on. And the very fact that you're talking about China backing the one with gold, and they need to buy gold, and they are accumulating gold, and they're accumulating it at the West's expense. And as much as Russian gold is sanctioned, it's sanctioned into the Western-facing markets, not sanctioned into the essentially into China, for example. And you talk about China backing the yuan with gold. You're talking about Russia ultimately backing the ruble with gold. But gold in itself, physical gold, is fungible. It's the only fungible asset on this planet Earth where you can actually pin it down to an exact exchange price based upon supply demand. So if you've got supply demand prices being developed in between Russia and China, for example, and those BRICS nations that interact with that, how can you have a separate price in the West? Because if that is underpriced and you want the supply, then you're just going to go to the West and take everything on offer, take everything that's unallocated, and then alchemize it into physical. How little trust there is in the let's just say the LBMA CME ring-fenced marketplace, and I think what's happened is because there's so little trust, even the World Gold Council came out and did a survey of, I think 36 central banks came out and said, we're buying gold directly from artisanals, we're not going through London anymore. So it's interesting. So that, if you've got, if the price isn't really being settled in the at the AM and the PM fixes in London, or the silver fix at noon, if it's not being settled there, then where is it being settled? And the thing is, what's the real price? And I think people are saying, well, I don't trust any of that stuff. So basically, I'm just doing deals direct. I'll take ownership stakes. I'll just literally make agreements. And I think the LBMA, CME are losing control to be able to actually set a price, an FX price for gold.
For years, global silver pricing has been set by the COMEX and LBMA futures markets. That dominance is beginning to break down. The gap between paper silver prices and the actual prices buyers are paying for physical metal has become too wide to ignore. This isn't a temporary blip. It's a clear sign that the old pricing model is losing its grip while the physical market begins to take the lead. AndrewMaguire puts it plainly: the cartel has lost control. COMEX and LBMA can still jolt the market during options expiries or on low-volume days, But the longer-term trajectory tells a different story. Physical demand is starting to shape price action. And as long as silver inventories in London keep falling, while both industrial demand and investor interest remain solid or grow, the pressure on the system keeps building. Look at recent COMEX data. In just 3 trading days, 1.3 million ounces moved into the vaults. What stands out is the registered category, the portion of silver available for delivery, which has risen 3% month to date and now totals 196.5 million ounces. That's not restocking for show, it's positioning for what comes next. Registered silver doesn't sit around for no reason. When it moves like this, it signals delivery expectations. In other words, someone, most likely institutional players, ETF custodians, or major industrial buyers, is gearing up to take actual metal, not contracts, not margin positions, but real silver bars. Maguire puts it best. The paper games are losing relevance, the cartel's influence is fading, and the physical silver market, slower, more grounded, but relentlessly firm, is starting to take control. Let's get back to the interview.
You know, what's interesting, you must have mentioned silver. We got a lot of silver subscribers. And you mentioned silver. And certainly, I think one of the things, shortages, you talked about shortages. And there's so much evidence of that. It's under our noses. And when you think about it, I mean, when was the last time we saw a massive EFP spread of nearly $1 in silver? In other words, the EFP spread would be, I'm now asymmetrically imbalanced against my swap position, and I have a short on the COMEX. And I'm now having to pay a big premium to buy it back. Now, we witnessed that on and it's just these footprints are in our faces. So on the 11th of July, that's when silver kind of broke out. And at that point there, we recorded, and we've got it recorded, a 92-cent COMEX premium, $4,600 per contract. Ouch, if you are on the wrong side of that, just to be able to buy back that position. And we saw that in COVID. We saw it with gold when it was nearly $100 premiums to buy back positions against spot. So, and today it's still 40 cents, and we've got silver approaching $40. So, you know, as you say, all of this evidence is under our noses. And yet, I think one of the key things that I'm trying to make the point of here is that the LBMA cartel has lost control of silver. And yes, we're going to see games with options expiry coming up on Monday. Of course, we're going to see the usual attempts, but it's lost control because the physical silver market is now the price of silver is being settled in a physical silver marketplace where you have to own a bar novel before you can put it up for sale. And this is really backwashing. And I think those days are numbered for the cartel. It really is. It's about valuing silver based upon a true physical supply, demand, price, and marketplace. And yes, obviously, and I fully concur with you. There's times, why wouldn't you go and attack the COMEX paper positions? Why wouldn't you, knowing very, very well that there are a lot of speculators in there, and you can work out where their stops are just based upon really, what the information is there. So essentially, then you can rinse those out, pick up the discount, and away you go again. But I think what a lot of people forget, and I've talked to a lot of people who have never been in silver before, and I say, do you know what? People forget that is actually money. It's actually a foreign exchange cross against the dollar, the yen, the euro, etc. It's amazing how few people, they think it's just another commodity, isn't it? But it's not. And I think while spot silver isn't yet Basel III compliant, it is a deliverable FX cross against the dollar. So essentially, yes, you would have to, in the past, when we've tried to buy in the past, it would be that plus a premium. And then you'd be even restricted as to how much you could have. But I think that is starting to evaporate, because if I now am trading in a physical marketplace and I offer a price, who somebody who owns a physical bar is willing to sell that for, then we've got a real price. And I think so. It's kind of that, in a sense, backwashes into the global fix for silver, which is the benchmark fix, where producers and refiners are locking that price in, or forcing hedging strategies upon your producers in a counterintuitive way. Essentially, I think the physical price is starting to evolve, and it's only just starting to evolve as this backwashes into this huge, as you say, 100 to 1. I mean, Jeffrey Christian at one point said 500 to 1, and so what? So it's backwashing. And I think this is a really great time, as far as I'm concerned. Yes, I own silver, but I keep saying this is a great time to be looking at silver as an asset class.
During New York COMEX trading hours, coordinated interventions occur. Bullion banks flood the market with paper silver, triggering massive sell-offs. In addition, these events cause stop-loss orders and algorithmic responses, accentuating the downward price movement. Market data reveals an extreme paper-to-physical silver ratio of 378 to 1. This disparity underpins why small trades can have a significant impact on pricing. Moreover, the manipulation of silver prices by bullion banks in 2025 has been repeatedly documented in research studies. What used to pass as market efficiency now looks more like a smokescreen. Gold and silver aren't just commodities anymore. They're the battleground for control over pricing power and financial independence. While Western systems lean on leverage and digital contracts, others are shifting focus to physical stockpiles, local production, and off-exchange trades. The transformation isn't loud, but it's deliberate. Every bar stored, every bilateral deal signed, moves the center of gravity further away from traditional price-setting venues. If the bulk of real metal never reaches the old exchanges, can they still claim to represent the accurate market? Or are they pricing shadows of a system already slipping into irrelevance? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.